This is James Zeng, and today I'm here with Clay Allen. And Clay is based in our Atlanta office, and I wanted to bring him in because he has worked previously as an asset manager, managing, I don't know, 15, 20 properties at a time. And so I wanted to talk to him about being an asset manager. So Clay, if you want to just sort of kick it off and we'll go through this presentation together.
Sure. I'm going to try to pronounce this name right, but it's Idowu Koyanika, organizational consultant and author who I believe lives in Raleigh. But he had a quote that kind of stood out to me as an asset manager. When money realizes that it's in good hands, it wants to stay and multiply in those hands. And a very simple quote, but very true. If you're a GP, you've done a deal or two or three, you're going to want to do more. And if James, you're an investor, passive investor, a lot of deals, you're probably paying close attention to the performance of the GP. And if they do a good job for you, I know that you're going to invest with them again.
Yeah, I mean, a lot of people, a lot of general partners, they generate a lot of hype, right?
Yeah.
So they, do a lot of advertising, get people in deals always. But then the easiest thing for a general partner is, look, if you do one deal, that deal does well. And, those 10, 15 people that invested with you in your first deal, now they tell two or three people and it all comes from referrals. Your next deal is going to be a lot easier to raise the equity.
Sure.
Right. But
Sure,
if your
absolutely.
deal falls apart and now you got to go out and find 20 new people and the 15 people are telling everybody else bad stuff about your deal, then so really the focus on asset management right now. So you broke it down into sort of four categories. So why don't you give us just sort of an overview and then we'll jump
Sure.
into each one of these.
Yeah, and what I'd add too is, as a GP, you're really the steward of the investor's money and their investment, obviously. And so you're going to find yourself having to work into an operating rhythm of some sort. And when I was thinking back through it, I thought through really four main activities here that I could see myself doing on an annual basis throughout the year, each year. First being planning, just do a really high level pass through of planning, budgeting that makes sense, business plans, reforecast. You want to keep an eye on cash, monitoring the investment. You're going to be talking with your third-party property manager and stay on top of the certain metrics that you need to be paying attention to, looking at the P&L, and of course the site visits. That's the fun part. And then communicating, you're going to be communicating with your investors, with the property managers, with the lenders, and I want to touch on that a little bit. And then transactions. I threw distributions in there. That's a transaction that's very important to your investors. And then refinances and dispositions will come along the way during your hold.
All right, so let's just jump into the first one, planning, when you go through these.
Yeah, sure. So as an asset manager for larger investment groups, I'm responsible for putting together a business plan. And the idea is to put together a high level roadmap for the group that's going to prepare the budget. In this case, we had in-house property management that would prepare the budget. In your case, as a GP, you're probably going to hire a third-party property manager. And in that case, you want to provide them with an idea, again, a roadmap of may set the tone for how the budget should play out for the coming year. When I say high level, I really mean high level. This is meant to be maybe one page, and when asset description, market dynamics, top priorities, capital needs, summary of debt. Those are the things that should be included in a business plan. And when you want to fit all that in one page, don't do a 6 font, right? You want to keep the same 12 font, and just be very succinct. Asset description. This is a 212 unit property located in Ackworth, Georgia. Has a good solid unit mix. Market dynamics. You want to point out areas that are things that's going around in the market that might affect your business plan or the execution of what you laid out for the next year or three, depending on your hold period. And it might be there's going to be a Kroger Acres shopping center that's going to be developed in the next 3 mons.
So Clay, on this business plan, so are you thinking that who are they giving? Who's the general partner giving this to? Like, is it going to the property manager or is it going to the property management company? Who are they giving this to?
I would give this to the property management company,
Okay.
who has identified a property manager or regional in that area who will oversee the preparation of the budget.
Okay.
This is a good document also to have for your investors,
Okay.
just to kind of keep them up to date.
Okay.
Yeah.
Perfect.
Yep. So yeah, and I put summary of debt at the bottom there. That's a good idea, just to kind of keep your eyes on what you have in term with the terms, interest rate, whatnot, and keep your eye on any kind of maturity that's coming up, but also any kind of hurdles that you might have signed up for. If you're with perhaps a regional bank, you might have a debt service coverage hurdle that you got to meet. So good to kind of keep an eye on that.
Yeah, just on that business plan piece, what I've seen some general partners do is when they close and everything is fresh in their mind, they'll basically take that one pager and
Mm-hmm.
they'll summarize, purchase price, rehab, and then the debt. And then because what happens is if any of your investors as a limited partner in your deal, they have to fill out a schedule of real estate if they invest in another person's deal as a
Yep.
key principal. And
Mm-hmm.
so you're constantly, as a general partner, keep getting asked, what's the debt? What's the maturity date? What's the
Right.
lender? All this stuff. And if you just have a one pager ready to go to
Yeah.
send to people and that you update quarterly, then you're good to go. Right.
Yeah.
So
Yeah.
it's
Makes
sort of
sense.
a growing piece. So
Sure.
maybe jump into budget and reforecasting from there.
Sure thing. And before I move on, I do want to point out the top priorities. That's kind of the meat of the business plan. That's where you're going to spell out what your execution is going to be. If it's value add, you're going to talk about how much you're going to spend per unit, how many units you're going to do. If you're adding washer dryers, if your idea is you want to cut expenses, you're going to have it in that spot. So again, that goes to the property management company to integrate into their budget.
What was the sort of top 3 things that you guys were spending like in the last 5 years? What was sort of the top capital, like what were the top things that people were doing? So for the groups that you were working with.
So when you say capital needs,
Yeah, either
yeah.
capital needs, like sort of what were those top priorities usually, like when you were coming in, let's say on an acquisition, you were buying a deal, and what were the top 3 things that you guys were doing when you're coming in?
Yeah, we were big value add players, and so you would see a healthy number for unit renovations. You would always see HVAC and water heater replacements. Other deferred maintenance items like wood rot. Again, we're buying value add deals, right? So they've been around for a little bit. They're going to have some needs that need to be attended to.
Okay, all right.
Yeah.
You want to touch on budgeting and reforecasting?
Yeah, the budget obviously is a very granular type of look, and the third-party property manager is going to put that together. Your job as the GP is not even to oversee the process, but to review it and approve it. And I have one here. You want to make sure that it's realistic and reasonable. What I mean by that, the realistic piece, it's easy for someone preparing a budget to be a little bit aggressive, to make it look good for a GP so they can get on to their next thing. On the flip side of that, the reasonable side, it's also easy for someone who's writing a budget to kind of sandbag and then make sure that they meet their bonus potential for the following year, and maybe sandbag on rent growth or even some expenses. So you want to make sure that you are being properly aggressive with the budget. Example, maybe if CoStar is saying we're going to grow 3% in this market, you might say, guys, I think you're better than that. Let's do 3.25, 3.5 for market rent growth. So there's many ways to skin that, but you want to have a budget that challenges your team and not overpromises and underdelivers.
And what is this comparison to PF? What is that?
It's just always to keep an idea or an eye on your pro forma, right?
Pro forma.
Gotcha. Yeah.
Okay.
You've laid that out with your investors, and let's say 2 or 3 years have gone by, and you're not referring back to that pro forma. You kind of need to know before the budget's approved that we need to push for more rent. We need to really cut our marketing expenses a little bit more.
All right. Reforecast?
Yeah, so reforecast. This is something that we made a habit of doing at both companies that I've worked with in the past. It's important because as you go through the year, you have to make sure that you have enough cash to obviously meet your debt service, but pay your investors, whether it's monthly or quarterly. And I would encourage you to look at this on a quarterly basis. A lot can happen in between those 3 months, and I would look out for things not just the above the line, above NOI, but below the line as well. One thing that's kind of snuck up on me in the past is a lender might wake up one day and it's say February or March, and they're looking ahead to when taxes are due later in the year, and they're going to say, wait a second, this isn't enough. Or maybe they've paid taxes out of escrow and you are less than 2 months of tax, monthly tax escrows. They're going to make you true that up. And so you want to catch things like that so that you don't get surprised in say September when you have a distribution coming. You're going to have, 40, 50, $60,000 that has to go to the lender.
Did you have a rule of thumb? So let's say if you have a 100 unit deal or 200, most of your deals were 200 units and plus, but let's say 200 units, is there sort of, a lot of people will have like a working capital number.
Yeah.
Where they sort of fund the account at the beginning of the deal. And then, it's going to go up and down. They might do some CapEx, get refunded from the lender. They might have, some unexpected things come up. Is there anything, how much working capital did you typically have on these deals going in?
So, it's the tale of two companies, right? I've been to different groups. Let's say the first group, the rule of thumb was 2 months, 2 months of operating expenses. And, those were, I'd say, long-term holds. So we had burned through any kind of upfront capital. So you didn't have that reserve. My other company, I would say probably 2 months of debt service was a general rule of thumb. We were shorter term holds, value add, probably average 3 to 4 year holds. And so we didn't see the need to hold quite as much, but in today's time, COVID, I wonder what most investors are thinking, to be honest with you, like what would be a more appropriate number. But I think the general rule of thumb is around 2 months of debt service or operating expenses.
Okay. Yeah. And so debt service is usually probably 1 month of operating expenses roughly.
Yeah.
And so, if you're doing a value add deal where you're putting in, 5 to 10 a door, you probably have a pretty healthy CapEx budget. But it sounds like in the first group, if somebody was coming in, it's more of a yield deal. They probably just have a fatter working capital budget because they're not coming in doing a ton of rehab on the front end.
Yeah.
The deal. Okay. All right. Let's move over to monitoring now.
Yeah.
All right.
So monitoring, and again, this is where you're really working with your third party property manager to keep an eye on the operations. And this can be the rhythm here can be weekly, monthly, quarterly. It's kind of up to you in a sense, but I would encourage on the far left side when we talk about traffic, I would be looking at that weekly. And I would kind of set the stage where your third party property manager, what your expectations are early on when you sign the agreement, right? With traffic, you want to monitor traffic and see what is driving the traffic. There's a lot of different marketing sources out there, right? And it's not just the ILS, it's not just apartments.com. It could be geo-targeting, it could be Zillow, just website traffic. There's a lot of different things. And so to know what's really driving the traffic will help you when you're looking at the budget, determine how you steer some of that money. So, looking down a little bit further, you want to look at how many tours you're getting, and from that, you want to look at how many net leases are coming out of those tours. And, if there's a general rule of thumb I've heard, I would say 25 to 30%, you want to see 25 to 30% conversion on the tours that come through. That's going to be market specific. But that's something to take a look at. If you're getting like 10%, and if you're getting 5%, nothing's, you're not really leasing a lot. You got to ask yourself, what's the issue? Is it product, people, or presentation? I say ask yourself that, but you can ask the third party property manager that, right? Because that's their role, and that's your job to kind of hold them accountable on that metric.
Do you have any stories of sort of something maybe you've switched at a property? Like, okay, let's say it's 5% conversions. Like, what did we change? to get it to 15 or 20 or 25% conversion at a property. Any stories like that?
I can't think of anything off the top of my head, but
Yeah.
I do know that we, as occupancy has come and gone, we have tried different measures. I have a deal, or I did have a deal up in kind of New York area, New Jersey, and it was struggling for a little bit, and we ended up increasing the ILS package to premium. We
What's
threw
ILS real quick?
I'm
Sorry.
sorry, the internet listing service. So that's when you hear internet listing service, ILS, that's apartments.com, other listing services where you market your property
Okay.
online. So yeah.
All right. And then, okay, so we get the traffic coming in the door, watch that. That's sort of the beginning, right? If
Sure.
you catch it in the P&L results, it's too late. It's already happened. It's
Yeah.
historical.
Mhm.
But the traffic is going to tell you, all right, what's coming up in the future for your property in terms of occupancy. All right, let's go to the P&L results.
So P&L results, obviously that would probably be more monthly rhythm. And I think the thing I would stress here is to look for early signs of a trend. And you know this as being a passive investor, you're going to get your P&L about, what would you say, 15, 20 days
Yep.
after the end of the month. And you only have 12 months in a year. And if you gotten to June and you haven't corrected or identified and corrected an issue, say with expenses, you're kind of baked at that point for meeting your budget for the year. So it's critical, as you're managing to an annual budget, by February, March, looking for any kind of common themes. Is your water expense over? Meaning maybe you have a leak somewhere. It could be anything, but yeah.
Yeah, and we were talking before this call. I only look at one thing really as a passive every month. I get a 150-page PDF from 20 plus properties, and I just look at net rental. So net
Sure.
rental is my trend that I'm watching. So there's a lot of things that you can watch, but that is my number one. So let's flip over to site visits. How often do you surprise them? Do you tell them you're coming? What do you do when you go see these properties?
Yeah, so I've done a little bit of both surprises and planned. I think my most recent stop, planned was encouraged. I kind of like popping in from time to time. I think that makes sense. You're the owner, you should be able to do that. So I would say this is kind of the fun part of the job. You go, and what I'm generally paying attention to are some of these check marks here. The drive up presentation very first. You only have one chance to make a first impression. And if you have cars, 20,000 pieces of traffic going past your property every day along a road, you want the signage to look good. You want the landscaping to be manicured and looking good around your monument sign. Make it inviting, right? So that's the first thing. Leasing center and amenities, that's where your prospects are going to camp out while they're talking about renting. And again, first impressions, you want your leasing center clean, always clean, not crazy, papers on the desk. Also looking at some soft things like your leasing consultants. Are they getting up and shaking hands? I know we don't shake hands in today with COVID, but are they acknowledging someone coming in the door, not just kind of sitting there looking at the computer screen and waiting for someone to say something to them? So being engaging. The tour route's important, right? That's where you're going to take your prospect to show the entire property. It's going to be your amenities. You might go to the model. You want to make sure that if nothing else, that the tour route looks pristine. So if you're tight on your budget, you need to focus on any one areas of landscaping or whatever. You focus on the tour route. And then this is kind of the interesting part, the vacant unit readiness. You talked about surprises, James. That, one thing you could do as a GP is get on site, pull up your phone, and pick a unit that's vacant and available to rent, and ask the property manager to walk you to that unit. And that way you get to see what the prospect's going to see when they're coming to tour it. So you're looking for any kind of dust that's sitting on the countertops. Is the paint on the molding, was it sloppy? Just a number of different things. This is going to be someone's home, and so you want to make sure it looks very nice.
Yeah, I mean, on actually as a general partner, I recommend walking all the vacants,
Okay, yeah.
because not only, yeah, there's going to be that one unit that that person wants, and that's great. But
Mhm.
in the past, we've seen where, sometimes people will use, um, I can't remember what it's called, but just sort of like LRO or Yield Star or whatever. And so they're pricing units like daily and back and forth, back and forth.
Mhm.
And sometimes, one unit can be sitting out there for 6 months.
Sure.
And we're like, why isn't this leased? Well,
Hmm.
it's like $100 over everybody in the market. And it's like the
Yep.
system's just not picking that up.
Sure.
And so if I was a general partner, I would go out, walk your vacants, make sure that, obviously they look good, but how long have they been on? What's the rent? And then what you're getting to the next point is, what are the comps doing? Right?
Yeah.
Are we falling
Yeah.
behind so that yeah. So go ahead and talk about
No,
the comps.
exactly. Yeah, and I like exactly what you said. I'll get to the comps in just a second, but you mentioned seeing all the vacants. That's a great idea. When I was working with my prior companies, I didn't have a lot of time in the certain markets I was in. We might have had 5 or 6 properties in each market, so I wasn't able to do that. But what I do is ask them to show me their most aged vacant, just to see what the issue was. To your point, but the comp shops, I think that's actually kind of fun, right? You get to see uh, what they're doing, how they look. And what I always do, I put be open, honest, and share. You'll find that everyone's kind of, for the most part, they'll share information with you. They'll share war stories, and they'll share with you what they've done to correct the issues they're having. So I've always gone in and I've said, my name is Clay Allen. I'm with XYZ management company, and I, we own this other property down the road from you. So we're the bad guys, right? But would love to talk to you, just see what you're seeing in the market, what your occupancy is, and they'll share exactly, what they're seeing. So yeah, be open, honest, and share, and you'll learn a lot.
It'd be better than coming in saying you're James Zhang and you're looking to rent unit 525 and what's the rent on this and what's the occupancy of this? Like questions that almost no renter ask, right?
Yeah, yeah,
Like,
exactly.
oh, what are you guys doing for concessions right now? It's like no renter asks question. Your
Yeah.
dollar per square foot seems a little bit high. Like nobody asks that type of stuff on the
Yeah. What's your
tour as
occupancy
a
this
tenant.
day?
Yeah. So um yeah, so I do like that. And especially if, you can come in, everyone, obviously if you go to 5 places or 10 places and, there's going to be some combative people, that's fine. But, you
Mhm.
can get a really good feel generally about, the market and what's going on
Sure.
in that area with these site visits. All right.
Yep.
So let's jump over to communication.
Right. So, we talked about the last slide, talking with your property managers, and that's the communication you need to have with them, really weekly, monthly, and quarterly. Communication, this slide probably speaks more to the investor and the lender. So I think what I want to stress here with the investor is, anticipate what questions they're going to have, be ready to answer those, be confident. Um, I have on here, be brief and concise. And what I mean by that is a lot of your investors they probably have other jobs, right? They're going to have day jobs that they're passively investing with you. And you want to be mindful of their time. Don't hit them with all these metrics that they might not understand. Share some general. I say speaks thematically here. That's something I've had a problem with in the past. I've had to learn, but you want to just speak in general terms: solid rent growth, increased traffic, things are going well, or we're having a little bit of an issue here. And then let them ask you more detailed questions. Now, I know that you're a passive investor. You know the business, and you like to become a better investor. So you like to hone in on some of those metrics, and that's why I say know the audience.
Right.
Know what their goals are. So if you're going to invest with someone, you wouldn't lay the expectation up front that I'm going to be in the business, so I know what's going on. But otherwise, I would probably keep it kind of high level.
All right. And then let's jump over to frequency. I'll give you my one. So I you said at the very least quarterly, right?
Yeah,
And
you're right.
so, of my, let's say 19 deals, one investor does monthly and then one does quarterly. The one that I get quarterly, it's almost as if it's been 5 years since I got an update from that person in
Yeah.
comparison to a monthly report,
Hmm.
right? It's
Hmm.
just, and so I think monthly, especially right now, monthly communication with the investor is huge, if not
Hmm.
more. And
Sure.
then maybe get into some of these other things that you're seeing on the frequency.
Yeah, I agree completely. Now, I'm going to jump to the bottom, post close, maybe even consider weekly calls.
Okay.
I would suggest, I've done this with my prior life with these other companies. After you close on a deal, you have some investors who are going to be investing with you that might not know you that well, and they've invested $50,000, $100,000. Who knows what the check was, but it's a lot of money, and and they're going to want to be a little bit closer to the action. So I would offer up maybe weekly calls for 8 weeks or so, and then tell them, after 8 weeks, if things are going well, we'll just go ahead and go to a monthly call, and let them kind of guide what their expectations are, and you can go from there. But other than that, I'm going to jump back up. I would say, consider a semi-annual webinar where they can see your face, they can hear your voice, you can show them pictures of what you've done in the renovations, perhaps, or if you did some deferred maintenance, show the before and after. Make them a part of the investment. Make sure they are a part of the investment in the day to day. Be available for any ad hoc questions. Pick up the phone and respond within 24 hours. If I had a lot of money sitting with someone and it was taking a week to hear back, that would make me nervous. So yeah, that's what I would say.
All right. No, I completely agree. Monthly, yeah, monthly for sure. And yeah, I remember, like, even though most of my properties that I invested are in Dallas, right? I don't
Mhm.
drive by them every month or every quarter. So it's great when the general partner will do, let's say, a video out there
Mhm.
and they show me, all right, this is a classic unit. This is the rehab unit. This is where your money's going. This is the
Mhm.
5,000 a unit that we spent. This is the rent that we're getting. This is the bump, and we're driving the business plan forward. I mean,
Mhm.
that it just makes it a lot better for me as a limited partner. And you can use these videos to send to your lender. You can send them to prospective people. I mean, there's so many
Mhm.
different ways to use that sort of case study type of video,
Absolutely.
not
Yeah.
only for your investors in that deal currently, but then it just provides a track record for going forward. So
No, that's great. Yeah, great insight. Yep.
yeah.
Yep.
All right, let's talk about how to work with the lender.
Yeah, yeah. What I would say is kind of similar to the investor. Of course, they are providing 65, 70, 75% of your capital stack. Treat them as such, right? I mean, now they have a lot of deals in their portfolio that they manage, but if you are providing timely reporting and picking up the phone when they call, it's going to go a long way. After COVID hit, we had a property down in Fort Lauderdale, and that's one of the harder hit areas, right? Broward County. So I picked up the phone and called our servicer in Charlotte and say, hey, we haven't talked in 6 months, but I just want to give you an update on where we're at. Things are going well. Sky hasn't fallen. He really appreciated it. We talked for 20 minutes and built up a good relationship. So definitely be proactive in your communication with them. Also, I'd say stay in front of any covenants, and I mentioned this a little bit on the business plan. You want to be mindful of any debt service coverage. These days, you have reserves, right? When you're closing a deal with agencies during COVID, so you want to know how long you need to maintain a certain debt service coverage, what the calculation of that debt service coverage test is, and when you can be out of that, when you can get that reserve released. So those are things to kind of stay on top of, and then monitor those escrow balances. Again, going back to the example of tax escrow, if that you get surprised, you want to make sure that you do your own forecasting with taxes, maybe insurance, and make sure you're not going to be short in the future.
So, this is lender by lender, investor by investor, but did you have a way of tracking sort of CapEx and that reimbursement schedule, right? So a lot of people will do, let's say, a Fannie Mae loan. They come
Mhm.
in, they get 75% of the rehab in the loan.
Yeah.
And now they've got 500,000 with the lender, and then they hold, 200,000. Was there ever a good way of sort of working with the lender and getting that money back faster? Do you have any tips on that? Because that is
Yeah.
probably one of the things that usually every lender is different. Every project is different. Was there any best practices around that?
I will tell you, I kind of cheated in that in both cases, we had a draw team. We had a good construction management team that handled those types of things, but I would find myself picking up the phone. In fact, I have a call later today with a servicer on that very issue. We have hundreds of thousands of dollars that's been pent up in draws, and the only thing that's holding up is a short-term radon test that we haven't been able to do because of COVID. So I'll pick up the phone and call them and see if we can get on the phone and work out some kind of resolution. But otherwise, it's really just sticking to the letter of the law and what's spelled out in the loan agreement, and being knowledgeable about how you're gonna float those expenses before you get reimbursed by the lender.
Right. Yeah. That's usually the main thing, is just sort of we go back to the cash flow issue, is that you've got only so much cash and you can't spend it all on rehab if you don't get reimbursed for it. So
Sure.
let's get into transactions as the last piece here.
Yeah, your favorite word, distributions, yeah. I guess, is with consistency. That's so important, I think. With the timing, go ahead and choose monthly, quarterly. I'd be interested in hearing your thoughts. I hear monthly is being tossed out more these days. Frankly, as an asset manager, I like quarterly, only because if I have some kind of event in January, then I have until, say, mid-April to figure it out. But if you have a healthy balance, monthly works totally fine from an asset manager's point of view. Be mindful of the rate you pay out. Obviously what you promise is what you promise, and you want to stick as close to that as possible. And what I mean by that, don't try to be a hero. And if you've had maybe one or two really great quarters, you want to distribute in excess of what you promised. I would say instead, take that excess cash, throw it into a reserve, because you will probably need it one day. So keep that in mind. On the flip side, if things get tight, you can't be scared to go to your investor and say, you know what, we really need to pull back. I think this is short term. We'll figure it out. But you don't want to cheat the property. Again, cash is the lifeblood of your investment. Without it, you're going to have lender problems. You're going to have mad investors. You're going to have vendor problems. So if you have to, cut.
Yeah, we could do a whole webinar on distributions and what you should not do. I mean, I personally like monthly, because a quarter in COVID era feels like 5 years. And if you do monthly, what I've seen people do well is, let's say you promised 10%. That's hard to get right now, but let's say you did promise 10% in 2015 or 16. And then what I've seen people who do monthly, they'll distribute probably 6 or 7%. So they'll hold back that remaining. So there's a little bit more cushion there. And then they'll do the monthlies. And then at the end of the year, they'll maybe true that up and just say, all right, yeah, we're going to keep going at the 6 or 7% rate. But then here's the extra 3%. There hasn't been any issues. We got all the CapEx done. We got refunded from the lender. Basically everything went smooth and everything hit the pro forma. So here's your extra 3%. And then that's sort of like a bonus for people, because people got used to the 6 or 7%.
Right. Exactly.
And then, in March with COVID, a lot of people just stopped distributions for a quarter, held the money, collections were good. And so now I see people turning on distributions, a little bit more conservative as well on the distribution. So that's where I'm seeing distributions. But to me, if you can set it up monthly, it is a way for people to remember you, in my opinion. Yeah. And because I would almost rather get a monthly, let's say $200, than a quarterly $600, because you almost just see that and you feel it, and it's just like one more touch point for the investor to you as a general partner. So
absolutely. Yeah.
All right, let's talk about the next two.
Yeah, refinance, during your whole period, if you've executed well in your value add perhaps, or you've had some market growth, you may be subject to better terms, maybe some cash out, and redeploy that money in another property or into the property itself. Keep an eye on that. Obviously, pick up the phone and call us. We have our eyes on the market, what the prevailing interest rates are, existing terms, if there have been any big sweeping changes in the terms, and it will help you out with the prepayment, what that would cost you to refi. with that said, I would say that, well, never mind. I'm not even going to go there, James. No, I think that should cover it.
Yeah,
Yeah.
on refinances right now, a lot of people are reaching out saying like they're just seeing the headline rates. They're saying, all right,
Mhm.
well, it's 3% rate and 4% rate. Like I just need to get some of that money. And yeah, you have to remember, like depending on your prepayment structure, if you have yield maintenance or even a step down prepay, you have to still pay that on refinance.
Mhm.
Some people think that's free, but no, you still have to pay that. And right now, Fannie and Freddie, unless it's pretty low leverage, you still have to put up a reserve. So some people are a little bit more
Right.
hesitant on putting up 12 or 18 months of a reserve. And so that's why, you got to run the scenario. Like a refinance I just closed last month, it was really, they were going from a recourse loan to non-recourse. All right, check. They
Mhm.
went from 5% to 4%, check. They went from, they got cash out, check. Like
Yeah.
all the things that, even in this environment, even with COVID, even with everything, even though it took
Mhm.
longer than they wanted, all that type of stuff,
Mhm.
they still did it, right? Because there
Yeah.
was enough check boxes. So you just have to run the sort of pro con list and figure out if it's the best thing for you right now.
Sure. Sure. Yeah.
So let's go into disposition. So at some
Yeah.
point you sell the deal, right?
Yeah, make it rain, right? That's where it happens. So I put on here when to consider. There can be a number of considerations for why to sell when. One being you've done what you wanted to do. Maybe you've reached your IRR target early. The company I was a part of, not afraid to take a gain. They would go ahead and flip it and put it into the next deal. Maybe the supply is ahead of demand. I talked about in another video with the market, the Midtown Atlanta market, lots of supply, and that's something to consider. If you need that money in 2 years, well, you still have to deal with a lot of supply. Do you want to have to deal with that? So maybe go ahead and cut your losses. Same thing with the neighborhood shifts. Maybe you notice that some of the retail is going dark, and that it's just not looking good long term. So go ahead and cut your losses there. Say leave meat on the bone. If you're a value add player, you know that there are other value add players out there. You want to make sure there's enough for them to play with, and then they'll help drive that premium up a little bit for the value add. As far as who, I would say to get at least 3 BOVs, and then have calls to review those with each of those groups. You're going to challenge them on what kind of underwriting assumptions they used in coming up with their value. And then think about what kind of marketing strategy. When are they going to take it to market, or when do they recommend taking it to market? It is. How are they going to market it? So ask those type of questions. This is probably something we could probably do another whole video on as well.
Yeah.
But yeah.
Yeah, I mean, in terms of dispositions, definitely reach out to us, Claire or I, just to probably get a debt quote and look at it from the eyes of the buyer, right?
Sure.
So if you send us like a T12 rent roll, we size the loan and we say, all right, you can go get an $8 million loan on this property. You can probably sell it for $10 million, $11 million. But if we tell you it's a $5 million loan, you're not getting 10 million, no matter what the broker says. You really have to understand the debt piece of it is important. And then also that's going to drive your value. But in terms of dispositions I'm seeing in Dallas right now, deals are coming back to market that were maybe listed in January and February. They're coming back on the market now in July, August, September timeframe. I think people have seen collections be steady, and so they're coming back on the market right now. So
Yep.
I guess anything else? I guess
Yeah.
you had a summary page
Yeah.
here.
Yeah.
Obviously, this was a lot of information. So, most general partners, they're getting, let's say, a 1% to 2% asset management fee on the income. So this is a lot for you. So maybe if you were to maybe give us a summary, sort of how you tackle this. Obviously, you had a lot of properties, right? But
Yeah.
then as a general partner, not only are you asset managing your deals, you need to go out and find deals. You need to go out and raise equity. So some people that have done really well in this business, what they've done is they have separated the acquisitions guy and the asset management guy.
Yep.
And they sort of run, when they want to do a deal, obviously their heads are put together, but then on the day to day, they will have one person do one thing and another person do another, just because it is a lot. So maybe run through this at a high level, and then
Well, yeah, I don't want to. This is really what I just went through. I just wanted to kind of compartmentalize it into the operating rhythm, if you will. This is not a hard and fast rule. Everyone's going to massage this a little bit as to when you do what. But this is just kind of how I see it, and weekly, monthly, quarterly, annually. I would say, to your point, James, when I was asset managing, I came on my last company. I had 12 deals, right?
Okay.
It was a little bit light because there was a little bit of transition, so I had only 12 deals.
12 deals, like 200 units average, 300 units. What
Probably
size?
300. Yeah,
300.
300.
Okay.
Yeah,
So
yeah,
good size. Yeah. So you're at 3,000, 4,000 units that you're managing.
yeah,
Okay.
yeah.
Yeah.
For exactly for a short period of time, and then it ramped up to 20, and more recently like 35 or so. But that's
Okay.
just temporary. But either way, when I was at 12 units, it's like, wow, this is great. I can really focus on some of the asset management related stuff.
Right.
So I found myself being able to reach out to local governments to ask for parking type relief in a certain property. I reached out to another local government to see if we could cut back some trees and get a better view of a lake. A number of things you can do if you're not too heavy
So
on
pretty
the
hands-on.
numbers. Pretty hands-on, yeah,
Yeah.
yeah. So I like your idea of separating an acquisition function and an asset management function, but I realize that's not necessarily what everyone can do early on. So yeah, I think if you're the GP and you're fairly new to the industry, lean heavily on your third-party property management, but you got to hold them accountable at the same
Right.
time. So don't let some of these things drop.
Yeah. So, I mean, let's just, so I just touch on some of these. So weekly, sort of just reviewing your occupancy. So a lot of times, you can go into the third party property management system. So whether they're running like Resman or Yardi or some of these different operating systems, sort of checking that weekly, reviewing the traffic, the occupancy, and then monthly, you're obviously going to get your package of financials. That's, 150 pages,
Yep.
understanding that and maybe having a call with the manager and regional, and then quarterly, really looking at distributions, investor communication. I'd probably put that in the monthly for me as an
Yeah, sure,
investor.
sure. Yeah.
And then, going out, site visits, I would almost consider that monthly if you can do it, if you're
Mm-hmm.
local. But if you're, flying in to Atlanta, yeah, maybe quarterly and
Mm-hmm.
doing the comp shops and everything like that. And
Yep.
then annually, definitely, resetting the business plan and the budget with the property management company, so you're on the same page with
Yep.
them.
Exactly. Yep.
So Clay, if anybody has any more questions about asset management, any more questions about Atlanta, anything like that, what's the best way for them to reach out to you?
Yeah. Love for you to reach out to me, callen@oldcapitallending.com, or you can reach me on my cell phone number, 678-357-2631.
All right. Thanks a lot, Clay.
All right. Thank you.